The Fed gives the banks free money. The banks then turn around and park that cash at the Federal Reserve to get a nice return. Zero risk. Nice. You came here for the truth, so let me unveil that for you. Today we're going to look at what's going on with the Fed repos. We're talking about the $1 trillion reverse repo operation. It happened. Yes, it did. We partied last night in the live Money GPS. For those who were there, thank you for joining. It was a fun time, no doubt. Today, number one, I want to talk about the repo crisis, of course. Number two, I want to look at the inflation madness that's been taking place. Got some new data around that. And number three, stocks drop. What's going on here? What does this mean for you and your portfolio? All of that and more. Let's go. Here we are, the reverse repo operations. We've been waiting for this day. You could see just over $1 trillion. We've been waiting a long time. And of course, like I said, we went onto the live session of the Money GPS and we all joined up. Thousands of people came in the room to party it up for the $1 trillion reverse repo operation. Now, I think it's important because it shows you what's happening to the system. Look, the Federal Reserve gave the banks 0% interest. The banks then take those reserves and put them back at the Federal Reserve to get a small fee. But look, when you're talking about $1 trillion worth, even if it's a very small bit of interest, that adds up. Okay, and there's something like 80 institutions or so that took part in this. You split that and you realize that they're making a lot of money doing this. And it's zero risk on their part. These are too big to fail institutions. Now, they could be loaning out the money to individuals. They could be loaning out that money to other businesses and so on. But instead, no, they found a way to recycle that money within themselves and make a good profit off of it. Kind of smart, isn't it? Well, look, cash flood drives use of Fed reverse repo to record $1 trillion. This is out of Bloomberg. We're going to look at this really quickly. If you want to read everything that is to do with the repo operations and so on, what I would do is go to a search engine and type in reverse repo operations Fed. You're going to get the Federal Reserve's website. You go there and they have a description. Then I would also look at Zoltan from Credit Suisse. He used to work at the desk at the New York Fed, and he has a lot of good insight into this, and he's done various, with Bloomberg and so on, interviews to break that down a little bit further. I talked about this extensively going back 2 years ago in 2019 when this was all starting to happen, the repo crisis. And of course, here we are today. Unprecedented usage comes just before debt limit reinstatement. Use likely to remain high for some time. An overabundance of cash in the U.S. interest rate markets has for the first time ever pushed the amount to $1 trillion. 86 participants. That's what it was. I remember that number there. And of course, it just shows you, all the details. If you want to see, there's the chart that corresponds to the information. So, remember that there's the reverse repo operations and the repo operations. And what we're seeing right now is the reverse repo operations, where the companies are putting their money, parking their reserves at the Federal Reserve. In addition to everything you're seeing with inflation today and the high prices, you also have to look at the fake indicators that they give us. And everybody's favorite fake indicator, of course, is this right here. And the reason, by the way, it's the most fake of all is because the Federal Reserve uses it as their primary indicator. Key inflation indicator up 3.5% year over year in June for the fastest gain since 1991. Now, nobody cares that it's going up really fast because it's transitory, it's temporary. Here it is directly from the BEA.gov, and you can look at June 2021, 3.5%. It's madness, but that's what they're telling us. We'll see what happens. And you look at these commodities whether it's lumber and copper and so on. This happens to be natural gas, and it has absolutely skyrocketed. Now, if I pull this chart back several years, you will see that, there have been instances when it has been more expensive. Like, look, I'll pull this back in the, early 2000s into the mid 2000s. You're looking at times in which it had been much higher. It's at 3.9 today. And there have been, if you exclude those few peaks that were there, it's at $6 and so on. So it's still lower than where we were previously, but many have said that this is the commodities super cycle. Now, let's get into the money GPS insights and break this all down. Banks are seeing uncertainty, so as a result, they are using the Fed's repo to gain essentially free money. Number two, we'll talk about this more in a minute, but wages have not risen for the bottom 80% of people. And number three, remember this, please, that if you see inflation, you can stay ahead of it by having a hedge against that inflation. A very simplified example is that if you believe that particular type of food product is going to be more next month or 6 months or a year down the road, you could potentially buy some of that today to lock in the price. That's just an overly simplified example, but I hope that makes sense to you. So let's get talking about the stock market. I wanted to show you this here and just more anecdotal evidence and anecdotal discussions, and this is something that I find weird, but it's Robinhood stock sales soured by investor confusion and valuation concern. I get this weird vibe like the guy from WeWork, and I covered that previously. I just kind of get the same vibe. Maybe I'm wrong. Maybe I'm totally off by that, but put it in the comment section below if you think something's real sketchy about this. But let's leave it at that. July jobs report could be what gives the market its next big jolt in the week ahead. What are they talking about? Because they're looking here at, as they say, the game changer, since a strong number could encourage the Federal Reserve to tighten policy, while a weak number could delay it from paring back the bond purchases. Oh my goodness. It's so hilarious. The markets are saying as long as they continue on with this garbage nonsense, well then, it's party on. Well, everybody who was on the live last night, we were partying for a different reason. We were partying for the $1 trillion reverse repo and watching the banks and the central bank doing business hand in hand, getting free profits from each other. Free money being circled around, and you get none of it. Okay? And meanwhile, they're looking at, hopefully the jobs numbers are bad so that the Federal Reserve doesn't start pulling back. Oh my goodness. Do you see what's happening? You find others out there who talk about the truth like this. Very few and far between. I'll tell you that right now. U.S. stocks slide after strong month of gains. So this comes as of the last trading day of the month. And, they're worried about China's clampdown on the tech stocks. They're worried about corporate earnings like Amazon and so on. But, you see the market in the direction it has gone. And I think it's important to address that. It's been going up so strongly. Retail traders buy the dip. Has that ever not been the case? Buy the dip in big tech, unfazed by earnings. Individual investors have piled into Apple and NASDAQ. Now, why is this the case? Now, I want to tell you that this could do very well. Absolutely. It could do extremely well, in fact. And if you look back in the past, it has done very well. But what I would say is that there's this line, buy what you know. And I think it's kind of silly because what that means is I use Amazon all the time, therefore I'm going to buy Amazon stock. Or, I have an iPhone, therefore I'm going to buy Apple. That's not the way you should be buying stocks. That is terrible. Okay, you got to spend time. If you're not spending time learning about the stocks, you're taking a huge risk. You've got to understand the fundamentals. You've got to understand the actual balance sheets, the inside, the accounting, some level of understanding of the stock. Unless you're planning on swing trading it, and then you don't need to know as much of that because you might be holding it for 2 days. So as long as there's no reporting of earnings and so on, the fluctuations come from different aspects. But if you're intending on holding that stock for a long period of time, my goodness, if you don't read about them, you're making a huge mistake. Now, I'll tell you something. What's been green lately is cryptocurrencies. And you could look at Bitcoin almost approaching 42,000 as I record this video. Look at other ones too. Even Dogecoin is at 20 cents right now. It's up. Looking at XRP, I've been seeing a lot of people talking about XRP and so on. So cryptos have been up after being pounded down for a little while here. Now take a look at this. This is the total debt versus GDP versus monetary velocity. And that's something that I believe is very important because, of course, there's two sides to it. And I talked about this many times before. But when they pump money into the system and they're not necessarily loaning it out, that drops the monetary velocity. This brings us back to the repos. They could be loaning it out. It could be productive, but it's not. It's just all about profits. While the US economy will indeed exit the recession in 2021, it may be a statistical result rather than an economic recovery leading to a broader prosperity. And this comes, of course, from Real Investment Advice, one of my favorite resources. The most significant risk of the latest stimulus package is a surge in inflationary pressures undermining the stimulus's benefit. That concern will manifest itself as a stagflationary environment where wages remain suppressed while costs of living rise. So you heard that. Check this out. Real average hourly wage growth for the bottom 80% of workers. It's down. It's down. So they tell you, oh yeah, you're making more money today. But when you actually break it down, like I wonder how this would be for the bottom 50 or the bottom 90 or what have you, and just to see that breakdown a little bit deeper. But I'm happy that they put this together. Consumers failing to make ends meet. You've heard that so many times before, but just shows you the gap between the real disposable income and the cost of living. And that's the blue shaded area. And it is just unbelievable to see this, see it the way it is. And this article here is talking about workers who changed their job over the last year are getting better paychecks than those who stuck with their employer. Job switchers saw their wages grow 5.8% because there's so many incentives today to get people in more than ever before. Whether that, some things like McDonald's and so on are giving out iPhones and sign-on bonuses and so on. But in general, there's higher wages that are coming around, more incentives because of some serious changes that occurred during this period. Then you've got this. Staffing shortage impacts trash pickup in Catonsville. And I just think this is Baltimore, by the way. And I just think it's interesting to see how some places are just starving for employment and others not the case. There's really a lot of pockets here. And I just wanted to bring that to you because it's not linear. The inflation is not linear. When you see these gurus telling you this is the way it is, this is the way it's going to be, and this is how it's going to all unfold, unfortunately, I'll be honest with you, they're lying. Nobody knows how it's all going to unfold. We have the data here today. We could say how it is today. How it will be tomorrow, that's anyone's best guess. I'm going to leave you with that. I just wanted to ask you that if you want to become one of the insiders, all you've got to do is go to the moneygps.com and you sign up. It's totally free. That gets you the video of the day. I'm planning on some much bigger things in the near future for it. So you could check that out. I'll put a card up here, or you could just go to the moneygps.com. If you haven't already, I appreciate it if you give me a like on this video, as well as go to the Instagram and the Facebook and the Twitter and all that, because I'm posting new content every day. I'm posting funny stuff on there. I'm posting shareable content that you can have for yourself and for others as well. So you can check that out on any of the platforms, search for @themoney_GPS, and you'll find me there. If you haven't seen this video already, you definitely want to check it out. It's right here. Click it and I'll see you there.